I believe that time frames is one of the most misunderstood topics when it comes to trading the financial markets. So many traders believe there are these magical time frames. In this episode, I'm going to explain to you certain time frames that I personally would avoid, and I'll also share with you how I'm utilizing all different time frames to unlock different types of positions. So we're going to begin with my favorite time frames. So the time frames that I like to use are the weekly, the daily, the 4 hour, the 1 hour, the 15 minute and the 5. Now certain time frames serve a different purpose. I might be utilizing the 4 hour for more of a swing style entry alongside the daily. And then when I get into the nitty gritty, I may be going to the lower time frames like the 1 hour, the 15, and maybe even a 5 on the 5 minute, but that's more from the advanced techniques. So before we get into the chart example, what time frames to avoid? If you're new, I would avoid things like the 5 minute. We do focus on the 5 minute, but that's an advanced concept. So you should have already mastered things like the daily, the 4 hour, the 1 hour, 15, etc. And then you get the opportunity to unlock that time frame. I would personally avoid going lower than the 5 minute completely, right? You see traders on the 1 minute chart taking too many trades, and I would say it's probably where people take most of their losses. You getting in on the lowest time frame doesn't mean always more precision. Sometimes you can get in too early and incur a lot more losses. You going to the lowest time frame doesn't guarantee the biggest risk to reward either. Otherwise, that would be the case like if who takes the most trades, they're going to make the most money. We know that's not the case. It's got nothing to do with that. The same way you go into the lowest time frame doesn't mean that. Even with the way that we trade, so we have our advanced concepts, which is more so on the 5 minute time frame. Just because you take an AFT entry doesn't mean that you'll make more profit than an original entry on, let's say, the 1 hour time frame or the 15 minute. Forget about time frames being the difference, the point that I'm making, that's going to make you the most reward. But there are certain ways when you link them together, that is what gives you more of an edge once you understand market positioning. Let's get into the example. And before we get further into this episode, if you're someone who wants to make sure that you're up to date with the financial markets, make sure you're subscribed to our free weekly newsletter, The Market Brief. You're going to have access to it every single Monday. It takes a few minutes to read, and you're always going to be ahead of the curve. So let's take a look at this example. We've got euro dollar here on the weekly time frame. How I'm looking at the market is that I'm looking for value areas. The most important thing to me is that I want to see where are the areas of value, because I want to position myself where the bigger players are stepping into the market. We know retail's not moving the market. We know the bigger players are stepping in. We want to figure out where are they going to be aggressive and how do we essentially ride the wave of the aggression. So I'll utilize things like the weekly time frame and the value area. So we've got euro dollar here. You can see that we had this sharp point. Price action had taken this higher. We was looking at this for a little while. So naturally, I want to see a weekly rejection. Now, as you can see here, that we've retraced pretty much 50% of the weekly candle. We want to see that type of formation, but it's not just the weekly on its own. And this is the point that I'm making. The weekly by itself is not sufficient. It's what is the makeup of the weekly and what do the other time frames look like in support of the trade idea itself. So the positioning, tick, that's great. You can even see from the perspective of this high was now taken out here. So this high took out this high, but we still left a gap. This high took out this high, right? So all of this gave us our 1, 2, 3 structure that we look for. We've got that finished of reversal. We start to sell off, and then we start to look into our lower time frame. So the positioning first and foremost was key, and then the time frame came in. And that's really the order that I wanted to teach you, where a lot of you are zoomed in looking at, oh, what's the best time frame, but you're not thinking about value. So where are the valuable areas in which that you want to ride the wave? So I'm not shocked that we had this run. We was looking at this for weeks prior. So if we go to the daily time frame, let's take a look. Now I've mapped out just some of the positions that I personally took, some of the positions that I would have missed naturally, as you're not going to get all of them. But what I would use in relation to the weekly, I would then be going to the time frame of the daily to see, right, does it support that idea that I'm looking at? So I'd go weekly, daily, and I'd work my way down to the 4 hour time frame. How I use the daily and the 4 hour is more of the next part of direction. So I'm more so looking for commitment and direction, not so much the entry. You can take entries on the daily and the 4 hour, even using our system, but I'd say that falls more into the swing side of things. And again, that's going to be dependent on your lifestyle. I know I can be more aggressive into the lower time frame, so I'll choose that. If I was going for a busier period, could I opt in for, let's say, more of a 4-hour entry? Yeah, of course, but as of right now, I'm very aggressive, especially this quarter. So many opportunities, especially on this pair. So as I go lower into the timeframes, I'm essentially building this idea of I'm looking at the bigger run. So let's say you've just started in Forex or you've been trading for a while and you're wondering, right, how do you guys trade? I'll go back to the daily here, just so you can see the bigger picture. I'm looking at the key inflection points is that where would, if the market was to become aggressive, where would people want to get out of their positions? So I'm looking for these inflection points. So you have our first one here and you have our second one here. So call this target 1, target 2. Those are my areas that I'm looking to get out in. Why is that important? Well, if you're too zoomed in, you'll cut your trade short. So I already understand that if the market's to be aggressive, which it already started, so it's confirmed that idea, it's highly likely we're going to take out these 2 lows and then move towards this low. So we've achieved everything that we mapped this out anyway. However, I then now know how I can manage trades better in the move to the downside. So if I go down to the 1 hour now, which is where this is what I would call executional time frames. So 1 hour, 15 minute, 5 executional time frames. Everything else is more analyzing the direction and the idea. So now when I go into the 1 hour, I can either do a few things. If I know what I'm looking for, and this is assuming your level of competency at this point, I can get in simply on the 1 hour, but I can also refine that a little bit further on the 15 minute. And sometimes, depending on the structure, not on this particular one, there'll be an entry for 5 minute. Now we did have an entry prior up here, but just ignore that one for just a second. But we're looking for the repetitive market behavior. Now, some of you are under the impression that how we trade is patterns, or we just look at patterns. I think it's very misleading when you're looking at it from the outside. That's not what we're doing. What we're utilizing is particular structures in relation to value areas and when bigger players step in. It's nothing new, just different wording. But the reality is we're looking to ride the momentum of the bigger players. The patterns themselves, they're not the catalyst. It's the market positioning and the footprints that are being left. So for example, it's no coincidence that this continuation price comes back up to retest the area before we then go. We're looking for that trade. And then what we're looking at is taking profit at these areas, right, at these lows, because these lows are going to be taken out and then we're going to form the next run. So when we're getting into these lower time frames, you can't unlock them until you've mastered the higher one. The lesson I want to give you here is that don't be that trader that thinks, again, a 5 minute time frame, I'm going to make more money. If you can't use the 1 hour properly, you won't use the 5. So take a look at all of these positions here that I've just showed you, and this is more of the top-down overview. Look for the similarities. So as you can see on this, price moves up, we've got this sharp move. This high doesn't take out that high, does it? But this high takes out this high, but not the high to the left. And then we leave a gap. This high takes out this high, and then we get that turning point in the market. Now, the beauty of that is positioning. So when I'm now looking at positioning, when it comes to this sell-off, imagine you were also looking for the sell, but because you don't understand the higher time frame narrative of that bigger move where the market's going to be continuously aggressive, you're closing your trade from, let's say I'm assuming you get in a similar area. You might close it here and you might have a 4-to-1 risk to reward, and that might be a strategy, fair enough. By not understanding the high time frame, you massively skew your edge because you're almost getting out when it's more likely for it to carry on going. Like when there's some ambiguity around massive profit taking and larger pullbacks, I understand not wanting to hold through them, but there's a difference between that than just reading the high time frame picture. So as a bare minimum, you'd hold to the low. And what could that be the difference? Let's say you get out of 4-to-1, that could be an 8-to-1. And that's just a subtle difference of just one simple move. But we had 2 entries within here, if we're going to go time frames, 1 hour 15, and then we had technically entry 1, entry 2, and then the lower time frame as well. So technically 3 entries within here, profit target in this area. We had an entry here, right, which was one of the ones that I got. And then the move to the downside, there I would say 2 entries in here, and then we had our entry in here, 2 entries in here, 1 entry there, 1 entry there. You wouldn't take this entry because, again, poor positioning. So again, good positioning, poor positioning. They might look similar, but one is good and one is bad. So it's just about understanding the run. Now, I've not even gone into every single position that was in this run. What I'm saying is this: if you don't know how to position yourself in the run, the time frame is useless. So I could use the 5 minute in the wrong area and get absolutely nothing and get loads of losses. And I think a lot of you traders are doing that. You're going into the smallest time frame possible and expecting that's where you're going to get your returns, but that's where you get burnt. That's where you lose your funded account. That's why you're in this vicious loop of just hitting the market constantly. It's like 7 losses in a row before you get a winner. That's not sustainable, is it? I'm sure you don't feel even great about trading that way anyway. You're just going to feel nervous all the time and anxious. That's like not a good way to trade. And you'll never do that on sizable capital anyway. If you understand how to use the time frames together, you'll be an absolute savage when it comes to the market, because you can use the weekly, the daily, even then, like you can go as far as the monthly if you really want to look at the high time frame, but that takes a long time to play out alongside the weekly. My personal favorite time frames are daily, 4 hour, 1 hour, 15 and 5, right? And it's about utilizing them. Daily and 4 hour is, again, it's more of that committed direction and bigger structures. 1 hour, 15 and 5, they're my executional time frames. So know what your time frames are and don't start analyzing on an executional time frame. I think that is what people's problems are. Say, for example, the 1 hour is an executional time frame. They're analyzing everything and they're so zoomed in and wonder why they're taking lots of losses. And all you need to do is zoom out, understand the high time frame narrative, and you could avoid so many of your problems. And I've seen them. I've seen so many of these journals of people that have sent them in. We now have students that have gone through the Rewired program. Now I get to see all different types of systems. People send me their journals just so I can give them just an over-the-shoulder look. And I can point out, and I don't even trade the way that they trade, and I can still point out obvious flaws in you're literally trading in a way that encourages shitloads of drawdown. So why would you want that when you could just look at high time frame narrative, still trade how you're trading, look at the high time frame narrative, don't cut your trade short, position yourself well, you'll make more reward, you'll avoid some losses, not indefinitely, but you'll get rid of quite a lot of losses, and you'll be better at trading. And just by default, you would be more profitable just by removing so many of the unnecessary losses where they're positioned poorly. Have some confidence that whether you trade the way that we trade or not, you're usually 1 or 2 decisions away from being successful, and it's not going to be a magical time frame. As to what time frames you need to be using, I was going to sneeze then. So I had the itchy nose and I was going to proper sneeze, and then I didn't. And you're going to understand how utilizing down to the positioning. I want you to think about positioning, and I'll get to that in later, is important once the trader itself knows where they're executing. I'm going to do that all again as well. Too much waffle burger.
Hello, welcome to this edition of Quickfire Questions with Mark Hutchinson.
Welcome to the trading den. What you got for me?
What's your favourite football team?
Liverpool.
Favourite takeaway food?
Pizza.
Favourite healthy food?
Pizza.
Favourite book?
Think and Grow Rich.
Favourite journal?
Mont Blanc.
Favourite watch brand?
AP.
Favourite car?
Oh, you probably caught me off guard. Favourite car, Porsche.
One place to live in the world that's not the UK?
Dubai.
Favourite podcast you've watched recently?
Andrew Tate and Patrick. That was epic. At Andrew's house. After he got out of the jail cell. That was phenomenal. And the one with Tristan as well.
Big question is though, if there was only one time frame, what is the time frame that you would choose?
1 hour. Definitely 1 hour.
Yeah.
Because at least on the 1 hour time frame, I wouldn't be sucked into too much noise, and I'd be able to zoom out enough to still see it. Like, for example, this is where people get confused. You don't need all of these different lines or structures on to see where you're actually at. You can still zoom out and go, right, I understand that is a big swing point. So if I'm zoomed in, I can just see where I'm positioned. So the 1 hour. If I was, like I could only trade one time frame, I'll go 1 hour.